Hi, this is Kevin Gormley, a CPA that does financial planning, and today I wanted to talk about something that Dave Ramsey has claimed a number of times, that if you use large cap growth mutual funds, you can get 12% annual returns. And as a matter of fact, someone took a piece off his website, cut and pasted it, and sent it to me and said, basically, I want to be like Dave. How come I'm not getting these 12% returns like Dave is claiming? And so I've followed Dave for many years. I live in the state of Tennessee where Dave lives, and I will tell you that there's lots of people in Tennessee that love Dave Ramsey. And if you say anything negative about him, you're risking being an outcast. I do have to say some positive things about him because they're true. That first of all, he's helped me. Years and years ago, I read Financial Peace, and debt became something that I really have tried to stay out of my whole life, and Hattie and I have been able to do so. So I think he does a lot of good with the debt reduction, and his message there is fantastic. So for those of you that love Dave Ramsey, I agree. The place where I don't think he's done so fantastic is setting expectations for investors, because investing is a long-term pursuit. It's not a game, and it's something where if you're unhappy with your current results, you're going to keep switching and performance chasing, looking for these 12% returns. And so I will also give Dave a pass because when he started saying these 12% returns, I believe it was back in the 90s. And if you remember back in the 1990s, returns were extraordinary. They were extraordinary. That means not ordinary. Many of the financial writers at the time said that they did not think those returns would persist. So there is a real danger of taking very recent events, it's called recency bias, and saying that I believe the future is going to be like the very recent past. And so I believe that's what happened. The issue is that he has been saying the expected returns would be 12% as long as I can remember, and then the actual returns show up. And are they really 12%? Expected returns, 12% based on very, very recent past, and it just hasn't happened. And so I wanted to show you the evidence today. So I picked a fund, American fund. First of all, it's not that easy for someone. I do not do commission-based investing. I'm a fee-only fiduciary financial planner and investing person, and I use mostly passively managed investments because I believe they're better. But for those that do want to use commission-based, the American funds I think are some of the best funds out there. And so trying to find a fund that's been around for 20 years and has done well wasn't really that easy, and I did find the American funds, which I think has had a pretty decent record. But if there's a fund that's better, I'd love to see the data, and there's probably one or two funds that has done 12% over the last 15 years. There probably is. And so all the ones that did really poorly all died, and that's why there's not a ton of funds out there. So anyway, I don't want to debate minutia, though. I want to talk generally about this. I want this to be about the ideal of setting expectations too high and then being disappointed and wanting to quit. So can you get 12% returns? Well, over this last 15 years, the American funds, American Growth Funds of America, had a very respectable return of 5.85%. It beat the S&P 500, by the way. Again, be careful of recency bias now, though. If you look here, the amazing thing about the last 15 years as being an investor, and I know why some people have quit investing, is that it was very tough. At some point after 2000, your $1 million, if you had that, would have become 700,000, and then it would have become, somewhere in the $750,000 range. And if you stuck with it through all of this, and you would have gotten this 5.85% return. This is not 12%. It's not close. It's not even close. I know there's been some arguments that he wasn't talking about compound interest. He was talking about simple returns or compound returns, simple returns. But I just think it's not true. Now, when we go out to 20 years, again, the returns were higher. And the interesting part of this American funds is it really had great returns the first 10 years, not so great the last 10 years. And I'll show you the last 10 years. Now let me bring in another fund that's more of a comparator, because some people may be saying, well, you're showing versus the S&P 500. S&P 500 has both growth and value. That's hard for me to say. Let's look at just a growth index. And so the Russell 1000 growth index is just the glamour companies, the high growing companies. And so it's a great index to compare it to. And over the last 15 years, it did 5.75. So once again, the American funds was superior. When we go to 20 years, American funds was superior. The last 10 years, however, the index trounced it. And so let's take a moment now and let me tell you that, yes, hope springs eternal, and you think you can find a fund that's going to do better than indexes. Let me show you that it's very, very hard to do. So this is the SPIVA US scorecard, and very well recognized group that compiles returns, and it was the end of 2014. I don't know if you could see that with my face on the screen here, but it was the end of 2014, and you can look this up. I didn't find 15, but it could be out there. Large cap growth funds, they take all these growth funds, and Morningstar says these are large cap growth. The S&P 500 growth, which is only, again, the growth part of the S&P, beat 96% of the other funds in 2014, 71% in the 3-year period, end of 2014, 5 years and 10 years, 91 and 89% respectively. This is the evidence that shows that you should not be using actively managed mutual funds. Yes, some will win. I don't deny that some will win, but most will lose. So getting back to our 15-year date, I thought it was kind of interesting to take a look at the Barclays aggregate, which is the bond aggregate. How did it do? Many people say bonds are not for winners. Bonds are, for old people. I think bonds are a very important part of a portfolio. If you're younger and you're not worried about losing your job and ever having to access that money, I think you can go all stocks. But for the other 98% of us, I think having a little bit of bonds, having more bonds as you get closer and closer to retirement makes a lot of sense to me. But last 15 years, 5% return annualized for the Barclays aggregate. So let me show you the dangers of recency bias, okay? One could see this and say that put your money in bond funds because they're going to return 5%. One could say that based on this data, recency. And the ride was much better than investing in stocks. And that stocks only outperform bonds by, less than 1%. One could say all these things, and if I said these, especially on the radio, I'd be called out and probably shot. The truth about bonds is that bonds have been on a tremendous bull market, an extraordinary bull market. Extraordinary, once again, not ordinary. All right, I'm beating a dead horse here. But look at the last 3 years. Last 3 years, you have gotten those 12% returns or nearly. And bonds actually have not grown much at all. You've gotten a 2.45% return. You see, bonds going forward now, we don't expect these 5 and 6% returns because they've had such a bull market and interest rates are so low. And when interest rates rise, bonds could actually have a negative return. So be careful of recency bias. Set your expectations. Diversify. Don't just use large cap growth mutual funds. Use growth, use value, use mid cap, use small cap, use foreign and domestic. Build yourself a diversified portfolio. Use passively managed funds. And so maybe you can't get 12%. Maybe you can. Again, I hope we get 12% return over the next 10 years. That'd be fantastic. But I think the issue is not about the messenger here. I think the issue is around setting expectations for people so they can stay with their investment plan. Thanks so much for watching. I'm Kevin, a CPA that does financial planning.